Hey, how's it going?
Good, Larry. How are you this evening?
All is well. All is well. A unusually busy Thursday, but no complaints.
Good, good. Good evening, Yomi. How are you?
Good, Harvin. How are you?
Man, I'm doing good this evening. Thanks for
All right.
Thanks for the emails back and forth today.
All right. Yeah. Thanks for the quick response too.
Yes, sir. Absolutely. Felix, good evening. How are you, sir?
It's muted.
Hello, good evening, gentlemen. How are you?
Good evening. We're doing good. Thank you for
Good.
coming in.
Thank you for the invite.
Yes, sir. Well, you know, we all have a good friend in Nick, and I haven't had the pleasure of knowing him very long, but we've had some real interactive conversations, some really good conversations, and so it's a pleasure to connect with you guys tonight. Mr. Stover, good evening, sir. If you guys don't mind, I'm gonna record this so that there were a couple of our constituents that couldn't make it tonight, so we'll be able to share the replay with them if you guys don't mind. Awesome.
Hey, gentlemen, I don't think I had the pleasure of meeting a few of you, so it's definitely a great opportunity, and I appreciate the time, of course. And my name is Larry. And great to meet you, Felix, Yomi, and Darren. We've met before, but everyone else, great to meet y'all.
I was actually gonna ask Larry to give us a moment of his time to give us. I asked him at the last minute, Larry, will you chime in? He is our tax IRS tax strategist specialist. When I tell you, Larry helps us preserve our assets and not give any more than the government's fair share of our money to them. He is that guy. I'm gonna tell you, I've never met a guy. And so Felix and Yomi, you guys look like you might be about my age. You know, I'm early 50s, mid 50s, whatever you want to say. Larry's a 30-year-old guy. Well, you know, it's the camera. If you're not Felix, I'm sorry. Don't. I've never met a guy like Larry, 30 years old, that has literally probably eaten the IRS tax code. And when I say eaten it, digested it, he eats it every morning. And I have never heard him stumped on a question about asset preservation. And more, you know, because we can all make a whole lot of money, but if we're gonna pay it all in IRS taxes, what's the motivation for that?
That's right.
Larry's a guy that I've heard him and watched him instruct other people to preserve their assets and minimize that burden. So for me to ask him to chime in tonight and for him to accept is a big pleasure of mine. So thank you, Larry.
No problem. Thank you, Alvin. And no pressure. You just raising the bar. You just raising the bar high.
Way up. That's okay. I'm gonna do it again. Wait till we get a few more people on. So yeah, it's gonna be good.
Is Larry also located in Dallas?
In Frisco, yes, sir.
In Frisco, okay.
Yeah.
Very good.
Yep. We have I mean, it's so funny that, and there are 5 gentlemen on this thing right now. Darren, he might be babysitting or holding this baby. He's got a beautiful 1-year-old, but there are 5 Black men on this thing right now. To me, that is amazing. 4 of the 5 are right here in DFW, and I would have never had the opportunity to meet you guys had it not been for Nick or for Clubhouse. And so that's how I met him and had the opportunity to meet him. And we met for dinner a couple of weeks ago, and I showed up and he and I met, and then one of our mutual friends showed up that I've been knowing her for a long time, and him and her have been doing business for years. So it just shows that they say 6 degrees of separation, but I think it's a whole lot closer than that. And it was just really a great opportunity to see that come together like that.
Yeah.
Mr. Stover, are you available? Show us your beautiful baby, or
I'm doing bath time right now, so
okay.
I can't I'm on the phone, but hello gentlemen. I can see you guys beautiful faces. So I'll pop on as soon as I get her down for sleep.
Sounds good. Okay. I'll tell you, Darren is another 31-year-old young man. His construction company does tens of millions of dollars a year in apartment construction and renovation. And he's 30 years old, at home every day at 6 o'clock, bathing his daughter, putting her down for bed, doing whatever they do at night, reading books. And I really wish, I say that's such a big deal for me because I didn't have that example. And I wished I would have been that dad. And I wasn't. So when I see these young men like Larry and like Darren really stepping out doing that, it really levels my responsibility to be a better leader and to bring these guys along with me. So,
Right.
yeah. It's about 5 minutes after. We'll wait about 5 minutes and then we'll start it up. And this thing, like I said, is being recorded, so we'll have an opportunity to share it with everybody that doesn't make it. Okay.
Perfect.
Okay.
Yeah. Speaking of kiddos, you'll probably hear my little two in the background. I've got a 4 and a 6-year-old that's getting ready for bath time right now. So I traded off with mom for tonight.
Thank you, Larry, for that. And we love the kids, man. So if they come in and jump in your lap, just let them do what they do.
Oh yeah. Yeah, see, I've got this virtual background, and I was on a call one time, and all you saw was a little head just kind of pop in right here, stare for a couple of minutes, and then just fade out.
Right. I'm gonna go grab me some water real quick. So.
Okay.
So, Yomi, Felix, I haven't had a chance to formally meet either of you yet. What do you all do? Tell me a little bit about yourself.
Yami is a veteran in the healthcare IT slash real estate world. Not as huge as you guys, but I have my own few properties that I'm doing in the real estate side. But primarily I am a healthcare IT engineer. I work for the #1 company in the world, and I've been there for 22 years. And I'm about to retire, so looking to grow in my real estate portfolio. So I want to learn more.
I see Felix with the thumbs down. Does that mean he needs to stay?
What the heck is retirement?
Well, we're getting to that age, you know.
You'll never win that conversation with me.
I know you
Anyway,
always say that.
So again, I'm Felix. Yomi and I, we grew up in the sandbox together. So ours is a brotherhood. We're not friends, and our families have known each other since we were children. Spent 16 years in the auto industry, from top to bottom, from bottom to top. And so that came to its logical conclusion. And I've been a realtor in the past 5 years. So I earn my living doing the business of buying, selling, and investing in real estate every day.
Awesome. So, well, you had the thumbs down. You told Yomi he's not retiring because he's not retired, so that doesn't exist. What's your retirement philosophy? Because that's something everybody is chasing.
Phase.
Okay.
Phase. I believe we graduate through phases of life. So what, quote unquote, is supposedly retirement is just another phase that we enter to do other things. Man is not with the absence of work. There's always work to do. There's just different phases of work to do. I mean, you just mentioned, like the other gentleman that came on earlier, that he's, looking to put his children down. As we transition into another age group, there will be other things. We begin to enter into a mentor-mentee phase of life, whether it's as a grandfather or as mentors to other people who are seeking to pass through what we've already been through. So the money part to me is not the end result. The impact that our lives can begin to make in the lives of other people through the phases that we enter into. I mean, you can imagine you can be an 80-year-old and you have a 60-year-old child, son or daughter. You're still a father to them, and there are still things that they can learn from you. So retirement, the way it's presented, is coming to a place where you no longer work.
No, that's not what it is.
Sit down in Florida, cross your legs, and just drink coffee in the morning, play golf in the afternoon, have dinner and go to sleep.
I can tell you, I think Arvin is retired now, and he's just helping everybody else out to make money while he's having fun. And I will let him speak to that.
Well, I think if retirement meant that if I stop today, would the light bill continue to be paid? Then okay, I'm retired. If retirement means getting to the point where impact is more important to me than the money that I make, then okay, I'm retired. Because that's why Larry at 30 years old is here with me and I'm 57. That's why Darren, who's 30 years old, is here with me and I'm 57. And these guys, I call them my mentors, but they may call me their mentor, right? So more than mentor-mentee relationship is a friendship. And I have something that I believe to be a skill that I don't mind sharing. And for me, it's absolute honor to get to do life with some of these young men that choose to be with me because of what I can add to their life and their lineage. So if that's what retirement means, absolutely, that's where I'm at.
And that's kind of like close to what I was thinking about. It's just closing one chapter and moving to the next. And but the major goal is to impact people in a broader perspective.
Correct. And I'm still at my office, so I hadn't gone home yet. I'll get there at the right time as soon as I can, and I'm fulfilling my responsibilities, and everybody knows that I will get there as soon as I can. Not 1 minute wasted where I won't be at home where I want to be. But this, for me, is more valuable because of the amount of impact that we have an opportunity to make than sitting at home watching TV. When I get there, the grandkid will still be there. He's 2 years old and he's climbing the walls right now, so no problem. He'll still be there.
I see one person, bank colleague, just joined us.
Yes.
Yes, I just did. How are you all doing?
Oh, we're doing great. How are you this evening?
Very well, thank you.
Good. Thank you for joining us. Well, I'll tell you, we're 15 minutes in, guys. If what I'll do is this thing's being recorded. If y'all don't mind, I'll just run through the presentation of what we're doing. Let Larry speak about some of the benefits of this type of asset, and then we can pass on a recording to the other guys or women and guys, if you don't mind. I'm gonna share my screen really quickly. All right. So, gentlemen, what we're doing is I'm Alvin Johnson. I'm the president of Hope Housing Foundation. Hope Housing Foundation is a 501c3 nonprofit affordable housing provider. What does that mean? That means that what we do, what our impact is the ability to provide housing where our residents get to live instead of where they have to live. So a lot of my background has come from I'm 56 years old. I've been in real estate 38 years. I started as painting houses cutting grass, then cutting grass to painting houses, from painting houses to a general contractor. From a general contractor, I bought and flipped several hundred houses back in the early 90s, late 80s, early 90s. In 1996, I opened my first mortgage company. I've run mortgage companies from 96 to 2008 when we had a major upheaval in the market. And at that point, I had already put together a nonprofit organization towards giving back for housing. And I met a gentleman that owned 16,000 units of apartments. And I went and laid my life down for him and volunteered for him for 13 months. And then he passed away. And I became the president of $1.5 billion company through service. So I learned the apartment industry really in a great way, from the upside and the downside. And about 11 years ago, I became the president of Hope Housing Foundation after that transition period ended. And we went out to go and make an impact in housing to buy as many apartments as we could. I had no money. I didn't have the credit. I built relationships along the way. We've been responsible for about 35 units of housing. Today, we own just under 1,000 units, or right at 1,000 units. We've bought and sold multiple developments. And I'll tell you, over the last 2 years of dealing with the rising property values, the rising cost of construction, it has been very difficult to find assets that met our capital stack requirements. And what I mean by that is when we put together our resources with our partners' resources and the debt, there's a certain level of capital or return that we have to put out to make these deals all work for us, and we couldn't find anything. So we got into the development business about 2.5 years ago, after doing 8 successful value add apartment deals plus several other development deals where we were the general partner. And we've grown our portfolio. It got up to about 150 million. We're back down to about 90 million now. I think it was 88 million, 300 and some odd thousand after selling a couple of developments. But we took the same spin on value add assets and took that to the development phase, where we could literally go buy a piece of land, entitle it, add apartments or some asset to that property, and expound on the value. And we put together a dynamic team to bring together Northgate Apartments. It's in Princeton, Texas, which is a submarket of McKinney, Dallas, Frisco, some of the best places to live in America over the last 5 years, as most of us know, because we've been here. And I'm gonna walk through this presentation and kind of tell you what we expect to be able to be delivered. And I appreciate y'all's time tonight. So we're going to go through the investment summary. This rendering in the back is actually the rendering of the apartments that we're going to construct. So, I mean, super nice looking high performance building that we're going to put in place here. It's a 506C raise where we're seeking to partner with accredited investors only. The total offering is 9 million Class A shares. And we believe that this opportunity to fill quickly. Who put this in? I'll be transparent with you and tell you that we have presented this only for about 2 weeks. I've met with a lot of institutional investors. I say a lot, probably about 10 institutional equity investors, and we'll see what happens after the 4th of July, the holiday. But when I met with Nick and had dinner with him a couple of nights and had an opportunity to talk to him, sometimes more than the thought process of partnering with a capital source that's institutional, that can bring a whole lot of money and all of that stuff. Sometimes for me, the personal relationship means a whole lot more than the access to capital or that. I'm a relationship person, and so that meant so much to me that he and I would break bread together and be able to do that and talk about some of our goals and desires for the future between us and who he thought some of his friends would really like to participate in. Here's a confidentiality disclosure. I'm not worried about confidentiality. Some people are. I tell people, if you can take my idea and go be great at it, please go be great. I don't care about signing NDAs or NCNDs, because if you can go do better than what I thought about, then it must have been meant for you to be good at it. Here's our investment summary, and just in the background, this literally is the building that we're going to put together. It's going to be super nice. We're going to walk through that. So what we're doing is a 200 unit Class A development. This Class A development will provide high quality finishes, granite countertops, dog park, swimming pool, 200 units, year built. This is 2021. I'll tell you, we signed a construction management agreement 3 weeks ago. My construction manager thought he would be able to deliver this product in 12 months. I'm giving us 18 months. So 18 months literally from today would be 2023, when I believe this deal will be finished construction. Our total construction price or offering price is right around 37 million. That price is still fluctuating a little bit today because construction costs are actually going down. So we have seen a run up in materials and concrete and et cetera over the last 12 months. What we're starting to see and what's projected for third quarter and fourth quarter of this year is that we will start to see some reprieve. So all of our vendors are literally starting to come back to us with better pricing. The proposed financing for this project is 75% of costs being 37 million. Lenders providing right at $27 million in debt at 5.25% interest rate. It's a 3-year term. The loan value, well, 73% of costs, or they go up to 75%. It's 3 years. We've got 2 6-month extension options if we think at that time that it'd be better to extend. And we'll talk about that here in just a few minutes of why that could be possible or why we would opt to do that. It's an amortized mortgage. It's amortized over 30 years. But again, it has a 3-year term and 73% LTV. What we're looking at as far as a refinance is going to be a HUD refinance loan. I'll tell you, we put interest rate here of 3.75. Today, those rates are sub 2.50. We're looking at 2.25% rates today, but we did not do any of our projections based on what today's interest rates are or what today's cap rates are. We went up on interest rates. We went up on cap rates, even though the industry experts tell us that rents are trending 5 to 7% over the next 5 years, meaning we should see a bump in rents of at least 5% in the next 2 to 5 years. We did not project that much, so we kept all of our numbers really, really conservative because we'd rather under promise and over deliver. And here we are talking about the conservative underwriting assumptions. For rent premiums, we used $100 instead of $150 per the closest comp. Our closest comp is 6.5 miles away. So based on where we are, a half a mile from an elementary school, half a mile from a junior high school. We're in Princeton, Texas. The schools are much like Prosper and Frisco, what they consider to be exemplary schools with great grades for the schools, for the kids. And we're a strong submarket. We are directly in the path of growth. That growth in the Princeton submarket today will probably mirror what Frisco and or McKinney has done over the last 10 years. There have been 7,500 single family home lots hit the ground in Princeton over the last 2 years. And that just shows you that that growth is going out there. The houses are building and selling so quickly. Anytime you've got that kind of rooftop action, to have a multifamily asset right in the middle of that, we believe is going to position us for really good long-term capital. We've got a 6,500 square foot clubhouse, which this is a rendering of it. Swimming pools and dog parks, just talking about some of the creative underwriting assumptions. This is a smart technology building, and I'll get to that in a few minutes, but what we're using is we are using what they consider a structural insulated panel, SIP panel. This high performance building will actually withstand winds of up to 200 miles an hour. It's seismic proof up to a level G for California rated stuff. HUD has approved this process just in April of 2020 last year. It's nothing new. It's a 30-year-old process, and we'll be the first to bring this to market. It's a near net zero in market in Texas, not market overall. This is a near net zero product. If these roofs were flat and we wanted to put solar panels on these roofs, this deal would not have a utility bill whatsoever, or electric anyway, because these buildings are so energy efficient. We're not going to clutter the roofs with solar panels, so we're going to make it look really nice, but we will have an opportunity to maximize the efficiency of these units, and I'll show you that through some of our extra income that'll come back to us. Our pro forma highlights: stabilized cap rate in year 3, expense ratio 38.29%. That's the only reason it's that high is because we have to model it this way, just so that we believe, so that the underwriters and everybody won't think that we're being super aggressive. We think it'll be super lower than this. We think it'll be somewhere about 33% on expenses, but we're not projecting that. We'll have a 1x8 debt service coverage ratio by year 2. Most of our lenders require us to have a 1.15 or 1.20 debt service coverage. That means if your debt service is $100, they want you to have at least a $120 net to be able to pay the debt, so that you've got $20 left over. So that's what the 1.2 is. We're at 1.8 debt service coverage ratio by year 2. We are advertising a 7-year hold period. In that hold period, we will have a couple of capital things that'll happen to us, where we believe that within year 3, when we refinance this, by the time we hit year 3 with the preferred returns and the accrued interest that will be made up by the time we hit year 3, you will have all of your money back with a return. And then by year 4, 5, 6, and 7, it's really interest on top of interest, and then there'll be an equity bump on the way out at year 7. At year 7, we're projecting this as a sale. This sale could be another entity that we put together. It could be an entity that will give us more than what market bears. But at year 7, we're proposing an exit of a sale that will bring us a $37 million cost asset at a $54 million. Sorry about that, at a $54 million stabilized value. Investor return 21% plus, and that is based on a 7-year hold period. Again, you'll have most of your money back, or all of your money back, with a positive return by year 3, and then the other periods 4, 5, 6, and 7 will just be interest on top of interest, and then we'll show you that here in just a few minutes with an anticipated exit price right around 54 million. Using those numbers, we used a very conservative cap rate of a 5.5 cap rate on an exit. Today, these markets are trading at a 4.5 cap rate. The industry experts at CoStar and JLL and your Colliers and Marcus and Millichaps of America think that these cap rates will be sub 3% in 2 to 3 years, definitely sub 4%, and that our interest rates will continue to trend down. We did not follow that model of projecting that, but if that does happen, then we will probably be able to exit by year 3 or 4 with the same amount of returns that it'll take to get to year 7. Larry, before I carry on, Larry, we talked last week about the year 3 refinance, the year 7 exit with the accelerated depreciation. Do you happen to have that spreadsheet available that we went through so we can bring it up and kind of walk through that a little bit? If you can
Yes.
find, yeah, go ahead and find that.
You'll have to give me screen sharing rights, and once you're ready, I can pull it right up.
All right. So, guys, what I want to talk about a little bit, I'll go through the capital stack and kind of show you how we put it together, and then I want Larry to talk about some of the distributions and things. Let's see, sharing. I am sharing. Larry, I'll get to that in just a minute. I'll find it, okay? I'm gonna stop sharing and then I think it'll let me. So what we're looking at from the capital stack perspective, we talked about a $37 million total capital stack, $27 million loan at 75% LTV or loan to cost. That deals at I think it was 545 just a minute ago. I can't remember on that spreadsheet. 36 months, 2 6-month extensions if we need to. Yeah, here it is right here. 5.25% interest rate is amortized over 30 years. What we believe will hit stabilization within 24 months. We'll use month 25 through 36 to get to a great capital position with our rents and with our incomes. The lenders only require us to hit 90% occupancy for 30 days, and they will be able to extrapolate those numbers out over a 12-month period to actually tell us what our loan would be. So we believe we'll hit that by month 24. These refinance loans usually take 90 to 120 days, and we believe we'll be able to definitely execute that by month number 36. Here's the refinance preliminary numbers, about a $35 million refinance. 35 million here, 27 million here gives us right about $8 million in proceeds that we will be able to pull out and redistribute back as equity. The first money that will be put back will be the money that will make up the difference between the 9% preferred that's been paid out and the 15% that's been accrued. So the portion of that equity will be used to do a makeup of 15%. So all the investors that put in, just let's use some round numbers of $100,000 for simplicity's sake. $100,000 investment on a 9% preferred will get you $9,000 in interest payments, preferred interest payments. If it's accrued at 15%, when we get to year 3 and we do a refinance, we will make up the difference between that 9% preferred and the 15% accrued. So essentially that $100,000 investment has made $15,000 per year. We've got $8 million here. 7 million of that will actually be used as distributions back towards the initial capital infusion that was put in. So 7 million of the 10 million will actually be paid out. So with that statement alone, an investor that puts in $100,000 investment or $1 million investment, whatever that round number is, will have received 15,000, 15,000, 15,000, which is 45,000, and then 70,000 of his initial investment, which puts him getting all of his money back, his or her money back. And then year 4, 5, 6, and 7 will actually give you interest on top of interest. And that our refinance will be at a 75%. The only reason it's capped at 75% because we're debt service reserved or conserved, which means that this thing is pumping out more cash where we could literally go up to 80 or 85% loan to value, but because of debt service coverage is limited to the 1.2, we're capping it at 75%. I'm projecting this at a 4% refi, which again, today the rates are sub 2.5, but let's keep it here. And then we've got a 30-year amortization schedule on that. So Larry, let's talk about on the refinance, we've got roughly 70% of the capital going back to the investors that have been invested. They've made 15% on their investment for the first 3 years. What happens at the time this refinance happens from a tax perspective, from a borrowed money perspective? And let's talk a little bit about the accelerated depreciation.
Yeah, absolutely. So, I think the thing to really understand, which, many people who play in the real estate space get quite, they tend to get this, but when you get to the larger multifamily side, that number just grows exponentially, is that, as Alvin was describing, over the years of the investment, you get the cash flow, which is great, right? You're getting a return on your investment, which has favorable tax treatment within itself. And then on top of that, when you get to year 3 and the refinance happens, or whatever year that the refinance happens, the cool thing that's going on there is all of that equity that's pulled out, that's distributed to the shareholders, essentially goes to them tax-free. And the reason is it's debt. Debt is not taxed as income. And so as you're getting the proceeds over the years, you'll have favorable tax treatment. Then year 3 happens, you get a larger payout by way of the refi. That refi is distributed to shareholders tax-free. That means you pay 0 taxes on that amount that comes back to you. And then as the investment starts to go along over the next couple of years, you still have income that you're earning, again, at favorable tax rates. And so I'm going to pull up a slide here that is a model that kind of outlines what a 7-year hold looks like. And I'll walk through these different stages and what it means from a tax perspective. So give me one moment here to share the screen.
You should have sharing rights.
Got it now.
Okay.
Let me go ahead and make that a whole. Are we able to see the screen here?
No, Larry, it went black. We could see it at first.
Oh.
There you go.
Okay, perfect. There we go. And we've got the investment case study up here. So I'll leave it like this. If we can see clearly, I won't do the whole slide share, but whenever you acquire these properties, one of the first things that you do, and this is multifamily investment 101, or even in many cases, real estate investment 101, is you run what's called a cost segregation study. Now, we understand what depreciation is, right? The IRS gives us a depreciation deduction every year based on the value of that particular asset. A cost segregation study comes in and says, hey, we know components of this building will not last 27 and a half years. So this study, this engineering study that's done, segregates, hence the name cost segregation, it segregates the different components and allows a larger amount of that depreciation to go from the back end to be dropped on the front end, and you can accelerate that and virtually take a larger deduction within the first 1 to 3 or even 1 to 5 years of owning this property. And so just as a broad, very, very broad example here, you look at a $45 million property, which generally gives you, a couple $1 million of depreciation a year. You could easily turn that into 10 to 15 million, if not more, of depreciation deduction that's dropped right on the first couple of years. And what does that mean for investors? That means you're cash flow positive, so you're still getting your returns throughout the year. But when you get that K1 at the end of the year from the property, it's negative. So essentially, you pay taxes on none of the proceeds that you've received. And so the first 3 years is where you really get the true benefit of the cost segregation study. And if you look at this model here, you'll see just as a rough estimate, we're looking at within those first 3 years that the average negative K1, quote unquote, that one would receive based on a $100,000 investment would be about $30,000 a year. So that as you're getting a $15,000 return that Alvin was mentioning, you're getting a negative K1 of minus 30,000, which means you're paying no taxes on the 15, and you're accumulating losses over those years. So you don't necessarily get to use all the losses right away, but those are going to be powerful as we get to the end and once we get to the exit. So that's year 1 through 3. Once you get to year 3, we talked about the refi, how that comes to investors tax-free, because that's debt that's being distributed, not income that's being distributed. So if you really look at this, you're talking about potentially 1 to 3, 1 to 5 years of receiving proceeds, but no tax implications, depending on what else you have going on in your world. Year 4 through 7, you're getting those same returns. Of course, we've used a larger amount of the depreciation on the front end. So those K1s that you're receiving, they start to shrink, but you've got suspended losses from the first couple of years that can help absorb any income that we have on the back end. And of course, when the big exit happens, that's when the $7 million that we talked about is distributed to investors, and that's based on your pro rata percentage. But the cool thing that happens there is either you get favorable capital gains tax treatment, or you have suspended losses that have been built up over the last 7 years that basically absorb the capital gain. So essentially, a portion, if not all of that gain, could come to you without tax implications. And there are a number of other things that people can do on a personal level to continue tax planning, but this is really the value, a huge value in terms of making these investments, having amazing returns over the year, and then being able to protect that from a wealth perspective, because very little or nothing is going out of the door to the IRS.
That's
Interesting.
perfect.
What's that? I'm sorry.
No, I was saying that was perfect. That was exactly. I just wanted you to share that part again, because a lot of what we do is not based on our desire to make money, but maybe not pay near as much out in taxes. So I'm gonna walk through some more of this capital stack and our project estimated returns and etc. Let me share my screen. Okay. So again, it's a $9 million Class A equity raise. We're expecting a 2.5 or greater equity multiplier. Means if you looked at that deal that Larry just put up, on that $100,000 investment, we were projecting about $265,000 in total payback. That's a 2.65% multiplier. So we're looking at a 2.5 or greater equity multiplier there. And then go through the property's description. Again, here is a partial rendering of it. This is another rendering of it. We're going to have a community clubhouse here. A lot of open green space, dog run and dog park, barbecue park with outdoor patios. So we're putting together a real community that is based on, maybe family, kids, the whole 9 yards. It's a 3-story walk up. We don't have any elevators, but it's a great building. And we believe this thing's going to do really, really well. Jay, I'm going to call you back. The asset provides 3 levels of luxurious smart apartments with all LED lighting, Energy Star appliances, LEED certification, all eco-friendly credits known today and into the near future. Interior corridors, which this is a walk-up, so we will have corridors just between there. We were going to have washers and dryer connections, and actually washers and dryers in each unit. All-inclusive billing of the utilities. And what that means, because with this building system, we have the opportunity to capture a big delta on our expenses. We have an engineer's report called a HERS index report that shows these buildings are so energy efficient that our utility bills, lights, electric, will not exceed $30 per unit. We have the opportunity to pass a 1 payment option on to our tenants that will include a utility billing of about $85 per month to $90, depending on the unit size, giving us a delta of money that we will make on the high performance of this energy efficiency, along with the internet. We're buying the internet from AT&T at the curb for $30 per unit for high-speed fiber internet. We will be able to resell that to our resident for $70. And I mean, that in itself is you can't buy that from Spectrum or AT&T or anybody. But us having that gives us about 45 bucks per month or 40 bucks per month in income from that. And the income from these extra items like the utility bill backs, the water bill back, the valet trash, and the internet provide more than enough income for us to service all of our maintenance. This building also being brand new has a 10-year warranty on all mechanicals, AC, anything that's mechanical has a 10-year warranty. So since we're not paying any any maintenance expenses, all of that money goes to the bottom line. Here's a schedule of what our rents and our units look like. 1, 2, and 3 bedroom units. We've got 12 3-bedroom units. We've got 96 2-bedroom units, 2 different floor plan sizes. And then we've got 48, 36, 92 1-bedroom units. And the average rent on the 1-bedroom, the smaller 1-bedroom is 203, down to 157 on the 3s. So we've got an average rent per square foot of $1.77. Our comps in this same market are about $1.90 per square foot. So we're coming in below market on what our rent levels are, which gives us a lot more confidence that all of our projections are going to be great. You know, if we had projected at the top end of the market, I'd be a little concerned about that. But we're coming in again below the market values. Yeah. Class A finishes give this newly built community a luxurious feel for the residents. We talked about that. The location summary. This is actually, well, the site looks about like that today. Here we are in this rough area. All of the soil has already been moisture conditioned for the buildings, meaning it's a shovel-ready product. The developers of this apartment building community also developed some single-family and townhome lots just behind us. So we're not out in the middle of nowhere, which, you know, if you look at that green space here, but just behind it, you see all kind of rooftops. So we're right in the thick of the growth of Princeton. And then we're going to come out of the ground before those townhomes do behind us and before the single family homes do behind us. And in an area where you've got an elementary school, a junior high school, and a high school within a couple of miles. Again, the junior high and elementary are literally around the corner within a half-mile each. And then the high school is just a couple of miles away. You've got an apartment community with a growing population. Everybody's not going to buy houses. So you've got a mix of single family homes, townhomes, and then apartments, and we'll be the apartment owners. This thing is really in a great position to do well. The area median income for this particular zip code is, this thing showed back in January 2021, 72,763. When I pulled the reports the other day, there were over 73,000. So when you look at a population that spends about 20% of their income on housing, that puts their ability to pay up to $2,000 a month in rent right in our purview. So we're not overpricing for the market. Few more investment highlights. Again, here's the area median income for the area. All of the soil has already been preconditioned for this, so it's a shovel-ready product. It's fully entitled for 400 units. We're doing 2 phases of 200 units. We have the ability to obtain all of the historically low interest rates today by doing this. It's literally 1.5 miles away from 380. You've got easy access to 75, and then the tollway, 121 tollway. If you take State Highway 5, I believe it is, runs on the backside of McKinney, put you right on 121. That'll carry you to anywhere in North Texas that you want to go. Here's a population of Princeton in 2020, 27,000. Median property values right at 200,000. Again, the population, the area median income for the households, and then the population with high school diploma or greater is 26%. Population trends and et cetera. I don't want to go through a lot of that. I have the offering memorandum that will literally, you know, I can send it to you for more information. Here we are literally 8.5 miles from downtown McKinney in Princeton, Texas. This corridor between 380 and Denton, all the way to Greenville. that growth, if any of you guys are in North Texas and been to the Prosper, McKinney, or Frisco area around 380, know that that has exploded over the last 5 years, and that growth has literally gone from Denton all the way to Greenville. We put, so that neighborhood that I talked about where we bought 81 acres and we were going to put 363 homes on the ground, that development is right here on Highway 69 in Greenville, Texas. Within 30 days of us having the tractors out there getting that ground ready for the neighborhood, LGI, which is a national home builder, came and put that whole development under contract. So we're in the process right now today of delivering them 200 finished lots, and they're buying 163 unfinished lots just because that growth along 380 is so phenomenal. They want it there. They're also building right here off of 380 in Princeton. They're putting in some homes in the same price range, starting at about 300,000. So again, for growth, here we are right off of Monte Carlo Road, right here in Princeton. So great area. Again, this is what the site looks like. This is just beyond us to the east. Just to the west of us are new homes, subdivisions going in, and that's you can see those big trucks like 10 feet underground. They have to remove that soil. The engineer's report showed that 10 feet down from the top soil level had to be removed and replaced. So the way they do that is they literally go in and remove all the dirt down 10 feet. Those dump trucks, you can't even see them from ground level. They're moving all that dirt out, moving it to another part of the site, and then moving it back in and compacting it and moisture conditioning it. And that's what that process looks like to stabilize the soil for the foundations in this part of Texas. Here's some renderings for the buildings. Front view, clubhouse view, side view. Going to be a dynamic project. We're super excited about the way this thing's going to look. Clubhouse view, dog park, of course, barbecue areas, luxury clubhouse, luxury pool area, smart home technology with all the green technology using our SIP panels. The cool part, I think that's we've just about reached. Let me go through the financial analysis and I'll tell you a little bit more about this. So we talked about the capital stack. GP's putting in $1 million. Typically, we're required to put in 10% of the equity, right at $9 million for the LPs, and the debt amount at $27 million. What I'd rather do, rather than go through this pro forma, I'm gonna go through my true underwriting pro forma because this has changed just a little bit. Here's a little bit more about me. Today, president of Hope Housing Foundation, the Surgery Management Group. That's our vertically integrated company. We've been in business for 23 years. I've been the president here for 11 years. Again, I told you about 3,500 units of affordable housing that we've done. When we put this together, we had 1,300 units. We've sold 232 units since then. So I've got a pretty great bio. I love to share it with you, but I'm gonna stop this share and I'm gonna show you my real pro forma that has changed just a little bit. Anybody have any questions thus far about what Larry and I have talked about? Ms. Smith, good to see you. You came in after we got started. So Larry and I have introduced ourselves. I'm Alvin Johnson. Larry West is with us. He's my tax strategist expert, super nice young man, smartest guy I ever know. I've never seen a cool tax guy before, but he is that guy. Also nice to meet you, Tayo. Same to you, sir. And let me open up my underwriting model really quickly. Yes, ma'am. Thank you so much for joining us. All right, I'm gonna open up this underwriting model really quickly. Screen share. Okay. So I'll show you a little bit conservatively how we did this. This is a full-blown development model, but I only use about 5 tabs of it. So here we are again, 7-year exit. It's 5 buildings. The total site 16.9 acres. This is going to take up right at really right at 9 acres, including the clubhouse. We did not do any rent growth for year 1 and year 2. And year 3, we're looking at 3% rent growth. Earlier, I mentioned that all of the smart guys being CoStar and all of your JLLs and Colliers are predicting a 5 to 7% rent growth in the next 2 to 5 years. I'm not going to play with this pro forma and show you what that would do to the numbers, but if we did that, it would be it would be great. We're running this. All of my projections are based on a 5% physical vacancy and a 3% economic vacancy, which means we're really accounting for only 92% of the units being paying tenants when we're fully stabilized. And then I've got a 1% income growth for other income, and I'll show you what that is. Year 1 and year 2, the only thing this OpEx dampening means is that year 1, while this is under construction, all of the expenses that would typically flow through to this property are not flowing through in year 1 because we are under construction and they don't exist. And in year 2, 55% of the units of the expenses will flow through because I'm projecting that we'll be fully stabilized or complete construction by 18 months, which gives us half a year. So I'm only dampening 45% of those expenses in year 2. Again, here's a unit mix. We went through that just a minute ago. I have this pro forma starting to bring income in month number 13. My project manager told us this thing will be fully completed by month number 12. And I'm not buying that. It sounds great. I'm going with an 18-month completion time, but the city of Princeton told us that as soon as one building is complete, we can start moving people in. So I'm giving us 12 months to complete at least one building where we'll start moving in tenants. And then by month number 18, we're fully constructed. And then what I have here is this thing will be fully occupied by month number 22, almost 2 years. So when I said 24 months of complete stabilization, 18 months of construction time where we're moving people in month number 13. So being super conservative with those models. And we have a market study that supports this absorption rate. So this is not just me saying if we build it, they'll come. We typically have, we literally have a market study that proves up this absorption rate, that if so many units hit the market, that these units will be absorbed. We're charging $45 a month for a washer and dryer in every unit. We're putting it in. If the tenants have a washer and dryer, we're going to buy it from them, and we're going to charge them $45 a month for brand new equipment that we can control. And those numbers are built into our completed model number. So this is ancillary income for us, which provides $100,000 a year. Not a lot of money, but I'll show you where that makes up. We've got 60 garages. That the market for garages in North Texas is $150 to $175 a month. We're below that market. That's another $100,000 a year. Not even looking at that though. I'll show you where we're really going to make an impact is in the utilities. I talked about the $30 per month utility costs that we're going to have versus the $80 or $90 per month charge that we're going to bring back is $288,000 a year, and our internet cost is another $168. Why are those numbers significant? Our total labor payroll cost for this development is $210,000 a year. Our utility costs alone cover all of our labor. We have no labor costs. The second thing that's really important here is that we have no maintenance costs because everything's under warranty for 10 years. The roofs, the AC units, the hot water heater or the boiler system, everything's under warranty. But I'll show you here that we did not take those out of our projections. We've got general admission, admin costs of $40,000 a year. We've got advertising. We've got our payroll expense. We've got make-ready expense. We've got our utility expense. So we've got a corresponding expense here. We've got $180,000 in utility costs, $288,000 in utility income. So we're offsetting that again. So we've got so many contingencies built in here. We've got 600,000 in real estate taxes factored in, even though year one, that, we won't see it, but year two, we will see it. Trust me, we'll see that. And then we've got our expense for the internet, which gives us the 37.69% expense ratio that we talked about. I'll get through this part really quickly. Here's our land acquisition cost of 6.9. We've got total hard cost construction of 21 million. Development of the land is 3.3 million. We've got a contingency of $1.3 million. We've got civil engineering cost here of 600,000. This project is actually already permitted, but because of this high performance building, we opted to go with a new engineering, get rid of those plans, leave them structurally the way they are and aesthetically the way they are, but come in with the SIP technology. So we're paying for that. That saved us $2 million on top of what our costs are going to be. The previous owners, again, started the construction here on the dirt, had this all permitted. Their construction cost alone right here was 24 million. We brought that cost down to 21 million. They had the same development costs. So spending 600,000 to save $2 million here was a great investment for us to get a better building, better product. We've got our interest reserve calculated here, $1.7 million, which means we're paying interest from day one. You'll receive your first dividend check within 60 days. That covers the 9% pref that we're going to pay out from day one, and then we're going to accrue up to 15%. It covers our debt service coverage reserve as well. We've got fees built in for all the banks, all of the lenders. We've got working capital. We've got another contingency. We've got our builder's risk, which brings this to a total capital stack of 39 million, 39.3. Again, here's our numbers. And then I'll run through here really quick. Here's our refi, but this is where the magic happens. Here's our pref that's paid out from day one. This is accrued. Here's our pref that's paid out in year two. This is accrued. When we refinance in year three, this is the pref that's paid out. So it pays out all of the pref from that year plus all of the accrual, plus there's $8 million to be distributed back to all of the investors, which gets you the 70% of your capital replaced plus all of your makeup to 15%. When we get to year 7, if it takes to 7 years, we will pay out continuously. Here's your pref paid out. There may be a few accruals along the way. You've already gotten all your money. Pref paid in year 7, additional distributions paid to the investors in year 7 to make up the 15%. And we're distributing right at 14 million, which is right at $7 million between the investors and the sponsors. If you'll notice on the sponsors, the GP, us as a sponsor, get only 10% of the cash flow every year. 90% of it goes to the investors until we get to the end of the road. We want to earn our money. We're earning your trust. We're earning your respect. And by the time we get to the end of the road, we're all going to have a big payday. And this is what Larry was talking about. We're along the road, 75, 80% of these distributions that will be paid out will be non-taxable because of the accelerated depreciation and the depreciation carry forward that you'll have. And this is pretty much my presentation. We've got a 21.6% IRR with a 2.4, 2.5 multiplier. I'll tell you sometime between now and August 1st, we're closing July 30th. These numbers may move around just a little bit just because construction costs continue to fluctuate. But what we're doing by doing that is just making sure that this development works for everybody, making sure all of our I's are dotted, T's are crossed, and holding everybody accountable. And man, I'm super excited that I had the opportunity to present this to y'all. Any questions, Felix, Yomi, Ms. Smith?
This is Banky. You said that you could guarantee 92% occupancy rate. How watertight is that? Can that be guaranteed?
No. Well, I'm sorry, Bonky. I did not say that I guaranteed that, but what I did say, based on the market of having all of the market in our area over 98% occupancy today, what we were doing, we were factoring our numbers based off of a 92% occupancy level, 6% below the market, and that's the projection, and we're using data just to support all of our numbers. If I could tell you, I've told you all the upside, all the good stuff that could happen. Let's talk about some of the bad stuff that could happen. What if we build it and they do not come? Right? That's the biggest downside that we could have here. What I believe, if they do not come as quickly as we believe they will come, our numbers will be pushed out a little bit further. We have a 3-year loan with 2 6-month extensions, meaning that if we have to push another year because our occupancy hasn't reached 90% for 30 days, then we've got another year to make that happen. So our refinance would not happen in year 3. It could happen in year 4. That's the worst thing that could happen, is that they will not come as quickly as we project they will come. But we're using data trends to support that. Data has been known to be wrong, right? But the worst thing that I think that could happen is they would not come as quickly as we projected they would come, which means we push back from year 3 to year 4. The beauty of everything in our projection, and I'm gonna share my screen again because I want to show you our safety net. Our safety net lies right here in year 7. We may not hit this number because this is a year 3 projection, and it may not happen till year 4. Our year 7 exit, it could happen in year 5, it could happen in year 8. But the beauty of what does happen is they're gonna come. They may not come as quickly as we think, but they're gonna come. And when the occupancy hits that 90% market level, these are our numbers. And whether this 13 million or 14 million gets distributed in year 5, year 6, or year 8, that may change the IRR projections a little bit because the money comes sooner or later, but the number still comes. And as a sponsor of this deal, if we had to give up $2 million of our upside to make sure that our investors still hit their projected returns, that's the kind of relationship that we want to have, because we're not into one-off deals. We're into long-term relationships. So as far as a guarantee, we cannot guarantee anything except delivery of the building, unless God comes back and something like that crazy happens. But we can guarantee delivery of the building. We can't guarantee delivery of the tenants, but all the data supports that this growth will definitely happen.
Thank you. That answers my question.
Okay, yes, sir. Good. That was a difficult one. I mean, that's the, what happens if they don't come? That's the hardest question to ask in any scenario. What happens if you show up at the aisle and nobody comes? I mean, it's like, I don't know, but we'll work it out.
Just to jump in real quick, I mean, your projections are based on standard industry practices. Builders build homes here in Maryland too, and we wish we could find land that you have to build. Here in Maryland, the construction of new homes has simply vanished due to a lack of land, and there aren't enough homes to come to the market fast enough for consumers to. But your projections, I think, you're talking about the sweet spot. Like I said, I came from the car industry. I love your back end. I love the numbers I'm seeing in the back end, that nicely layered protection for, that offsets the upside. I think that's extremely innovative, and that excites me. Mm-hmm. Very good presentation. Thank you for that.
Well, thank you. I'll tell you, we've all had a lot of practice. You know, I'll tell you my age, right? We're not into practicing. We're into delivering impact. This will not only impact the community of Princeton, Texas, not only our organization and your families and what, you know, money's just money. But I think we all want to do good while doing good. And that's what we have an opportunity to do here. And that's what excites me the most. Ms. Smith, what about you? I see your beautiful picture, smiling at us. You have any feedback for us?
I was actually driving, so I just got home. But yes, thank you very, very much for the presentation. I will, I kind of jumped in late and I was driving, so I couldn't see all of those numbers, but so far so good, sounds good. I may have some specific questions. I will reach back out to you. Or my husband was actually on the phone as well. I hope he was listening a little better than I was, and so I'll ask him if he can fill in the missing gaps for me.
Great. Well, and I will send out tomorrow. I'll edit this video and I'll cut out all the 15 minutes of me and Larry clowning before y'all got here, and we'll send this out as a replay. And if you have any questions after that, just feel free to let either Larry or myself know, and we'll follow up that way.
Yeah, just a quick question. This is Tyre. Yeah, thanks for the presentation. I'm actually at work, so I mean I missed most of it. But
I like that golf course background that you're on with that picture, though.
Yeah, thank you. One or two things. One, why Princeton? Two, are there any major companies that are moving into the area, say within the next 5 or so years? We have a lot of, companies moving into Dallas now, especially in the Austin area. So I mean that's just my question for now. I mean, why Princeton? I mean, it looks like such a fantastic project. Know that everybody, we're moving away from Plano, we're moving away, past Prosper now and all that stuff. But yeah.
For us, Princeton came up only because, why did I choose Princeton? I'll tell you, I was driving back and forth to Greenville just about every day saying, man, look at all this development happening here. I wish I could be a part of this. And a year later, my broker called me and said, hey, Alvin, man, I got a deal in Princeton, Texas. It hadn't hit the market yet, but I'm working on my offering memorandum. When it hits the market, I think it'll go really quickly. Do you want it? And I said, yes. We put it under contract immediately, only because I saw the path of growth. I was driving to Princeton every day going to do that development. And I'll tell you, when I started 2 years ago, going out there, it would take me 35 minutes, 40 minutes to get to Greenville. Today, it'll take you an hour and a half to get to Greenville just because of the traffic. So the path of growth and all of the people going that way, I don't know where all these people are coming from that are literally coming to the Metroplex. I don't know what's pushing people to move to Anna, Texas, to Prosper, Texas, or Salina, Texas. I don't know, because there are no major industries there. But between Greenville has L3, which is a big governmental contractor that works on the stealth bombers. So that's a big industry there, and a lot of supporting companies that support that industry. I don't know what else is out there. So I think, I drive literally an hour every day to work from Cedar Hill to McKinney. I think people don't have a problem driving 30, 45 minutes from Salina, Prosper, Anna, Princeton to downtown Dallas, McKinney, or wherever they need to go for work. So I think this place is just growing so fast that there's no rhyme or reason to wait.
Alvin, I'm not sure if you also know that the Redeem, the camp is right close to it.
The camp?
Yeah, for the Redeem. Have you heard of the RCCG?
I have not.
Okay,
Oh,
that's in Greenville or?
Yes.
Yeah.
That's only 30-20 minutes from Princeton. Is just right in the center.
It is.
That place is huge. It's going to grow fast.
And what is that?
It's RCCG. It's the we call it the camp for the Redeemed Christian Church of. It's a Nigerian huge organization church.
I did not know that. Okay.
Oh, you need to check that out. It's huge in that area. Yeah.
And I'll tell you, I hope I don't offend anybody because I don't know who's going to watch this, but some of the people told me that Greenville, Texas was really synonymous for KKK and really non-positive Black things happening. And for us, we were the largest developer of a neighborhood in Greenville, Texas for a guy that looks like me. So I thought that was pretty amazing. The pastor of the church that sold us that land told me that, and I was like, oh, okay. That's not a driver for me, but if it makes everybody else feel good, then so what? But that I didn't know that area was holy land, so that's really cool.
What's the population of Princeton? How many people?
I think that report showed, hang on, let me see if I can find, I think it showed 27,000 today.
Yeah. Is it larger than Anna?
I think it's about the same because Anna is growing, Anna and Melissa are growing about the same rate.
Yeah, Anna is growing pretty fast. Yeah, okay.
Yeah.
Okay.
Well, any other questions? Also, you have any questions?
Did you have any hospitals close to Princeton? I know there's one at Greenville. Is there any close to Princeton?
Yeah, there's one right on 360. I used to live in Prosper. So yeah, there's one on 360, a huge hospital that was just built on 360. And that's not far away from Princeton. It's only like 15, 20 minutes.
And we just completed one in Prosper, Cook's Children's. We just built a children's hospital in Prosper.
Okay, so I mean, those might be potential clients.
Yeah, we just completed one in Prosper.
Okay.
Well, I think from Princeton, if you went down State Highway 5, you could be at that hospital off of 121 within 10 minutes. I think it's about 8 miles. So, well, ladies and gentlemen, thank you. Yeah, hey,
all right, thank you very much. I'm about to sign out. I'll be looking forward to receiving the recording, and if I have more questions, I'll get back to you. Thank you for the beautiful presentation.
Thank you so much. I really appreciate your time.
All right, take care then.
Yes, sir.
Okay, bye-bye.
Bye-bye.
This is Osa. I just want to say, wonderful presentation. I love the numbers. Hey, what really got me going really was the cost seg. I mean, my goodness, that's, I understand what that is. I know what that is. I have been there and I love it. Thank you.
Well, thank you so much. Also, we'll get this recording sent out to you guys. And again, if y'all have any questions, if you want to see the private placement memorandum, please get with me. I think Dr. Nick may reach out to you guys just to talk to you a little bit more. So again, thank you for your time tonight. I really appreciate it. And feel free, when I send the recording out, I'll put Larry's email there. Larry's going to be a great asset for you guys. I'm sure you all have accountants and tax guys and et cetera, but I've never met one as progressive and understanding as Larry. Don't let the bald head and the young child face fool you. This guy is super, super smart. So thank you again for your time. Ms. Smith, good to see you. Felix, thank you.
Thank you.
Thank you.
Yes, sir. Y'all have a great night. Bye-bye.